What's up, guys? It's Dan from Coin Bureau Trading. Today, we're going to talk about what CME gaps are, why they always get filled, and why they're going to be gone sometime in the new year, and why that's going to be very good news for the crypto market. If this is the kind of content that you enjoy, then be sure to smash that like button, subscribe to the channel, and ping that notification bell. Before we get started, do keep in mind that nothing in this video is financial advice. It's just my personal analysis of the crypto market. Your analysis could be different, and if it is, that's awesome, because the more difference of opinion that we have, the better traders and the better investors we're all going to become. So starting off, guys, taking things from the top, for those of you who don't know, the CME is basically like some large institutional exchange. I believe they're the largest derivatives exchange in the world, meaning like all this futures trading, like if you're trading futures for gold or for stocks or whatever, it's all done through the CME, which is of course based in the US. I believe it's Chicago Mercantile Exchange. So I believe they're based in Chicago, logically. But in all seriousness, what's really interesting about the CME, guys, is that of course a lot of people, and if you're into like gold and silver and whatever, you might have heard that a lot of people allege that basically institutions will use futures trading to manipulate spot prices. And I believe there's some truth to this. And it's very simple, guys, because for example, let's say you're shorting a stock. What that means is that you go to someone, you basically borrow a stock from them. So for example, you're shorting Tesla stock. You go to someone, you borrow a stock from them, and then you sell that stock, and then you basically promise to bring back and return that stock to the person you borrowed it from at some future date. So what you're basically betting on is that when you take the stock today and sell it today, when you buy it back later and give it back to the person who lent it to you, that the price will be lower, so that you'll basically make a profit, if that makes any sense. So you're buying today, you're selling it now, then the stock drops 50%, you buy it back, and then you give it back to the person and you make whatever it is, a 50% profit, right? I hope that makes sense. So this is the really interesting thing, is that if you look at, I believe the derivatives volume, it's probably not for every asset, but the derivatives volume for most assets is way larger. Like the derivatives market is way larger than the spot market. There's more people doing these types of bets than there are people actually actively trading on the spot markets. And if you think about it logically, like again, if you're someone who's investing in Tesla stock in the spot market and you're wondering why is the price fluctuating so much, it might not be because someone is buying and selling because they're betting against Elon or whatever, or like I don't know, like speculating around like earnings. It could be related to, well, I mean, I guess technically it is speculation of earnings, but it's not coming from spot buying and selling. It's coming from someone who's saying, hey, I'm going to bet against Tesla, so I'm going to go to someone, borrow a bunch of Tesla stock, and I'm going to sell it on the open market. And logically, that act of selling as part of the short can suppress the price. I know I'm butchering the explanation, but this is a very simple explanation. Is that key takeaways is that the futures markets are way bigger than the spot markets, and because of how futures work, it can therefore have an outsized impact on the spot market. So when the CME introduced Bitcoin futures way back in December 2017, what's really interesting is a lot of traders have argued that since that time, Bitcoin and the crypto market has been manipulated by institutions. And, I wouldn't necessarily say that's the case. And I mean, we're kind of going to be discussing that today, but that's basically the argument, is like, look, because futures are such a bigger market, and because they have such a profound impact on spot markets, the moment that a CME basically introduced Bitcoin futures is when Bitcoin started being manipulated by institutions. Only like a little problem with that theory, and that's the fact that the CME, I believe off the top of my head, it only makes up something around, I don't know, like 20% of all futures trading on Bitcoin. So it's not a very big, like most of the futures trading still happens on centralized exchanges in crypto like Binance and Bybit and these guys, right? So the CME is really a pretty small slice of that. And you might be wondering, it's like, well, if the CME is so small, why does the CME gap, why does it have such a profound impact? And what even is that? And I guess I'll start by explaining is that, and I guess more importantly, why has everyone been talking about the CME gap, so much over the last couple of years? And the answer, guys, basically has to do with the introduction of the spot Bitcoin ETFs. What most people don't understand is most of the spot Bitcoin ETF demand comes from retail, around 80 to 90%, depending on your source. And then the remaining 10% is mostly institutions that are doing something called a basis trade. And I'll use Athena, guys, as an example of how the basis trade works. So the way that Athena works is basically you deposit, for example, USDT, into Athena. Let's say you deposit 1,000 USDT into Athena. What it will do is it will take 500 USDT and it will buy Bitcoin, just regular Bitcoin, and then it will use the other 500 USDT to short Bitcoin with 1x leverage. And what that basically does is that if Bitcoin's price, let's say, goes up by 10%, then the short will lose 10% of its value, but the physical Bitcoin that was bought goes up 10%, so it kind of balances out. So you still have $1,000. And then on the flip side, if Bitcoin's price falls by 10%, then the short goes up, the value of the short position goes up by 10%, like it's 10% in profit. And then the spot position is down, like the physical Bitcoin is down like 10%. You're like down 10% on that physical Bitcoin. And you might be thinking, well, what's the point of that? What's the point of having basically like, what's the point of having a trade where, regardless of how the price moves, you have the same amount of money? The answer, guys, is basically fees. When you have these short positions open, especially when crypto prices are going up, having short positions open is very profitable, because what basically happens is that people who are going long have to pay fees to the people who are going short, and those fees can spike quite a bit. So you end up with, like fees of like, let's say, equal to, let's say, interest rates of like 15% or 20% or 30%. And what Athena basically does is they basically look at this and they say, hey, what we can do is we can basically, buy spot Bitcoin or spot Ethereum and then short Bitcoin or Ethereum with 1x leverage. And then what we can do is we can basically gather those fees, whatever it is, from all the people who are paying the fees to the shorts because they're going long. And because if Athena has all these open short positions, they're earning all this interest, basically earning all this interest in the form of fees. And then they basically have a stable coin on top of that, and then have the fees go into that stable coin. And that's where you get the yields for USDE. I know it's a little bit tricky, but the key takeaway is that but basically by the basis trade involves buying a spot of an asset, spot Bitcoin, shorting the future, and then you're basically earning fees in the background. And what TradFi institutions do, of course, is that they keep the fees for themselves. That's how they make the money. But for Athena's USDE, it passes on the fees basically to USDE holders in the form of yield, and eventually to ENA holders, to holders of the ENA token. And that begs the question, okay, well then, so why do these CME gaps happen? Basically, guys, the reason is that when there's a deviation between, and maybe I'll show this chart here, when there's a deviation between the physical, let's say the price of Bitcoin, and then the price of the future, like if there's a deviation specifically of the spot price, then that basis trade kind of breaks. Like I'm trying to think of an example. Like, I mean, it's kind of hard to explain because it's very specific to TradFi. Like in crypto, doing this basis trade is very good and very liquid because crypto markets are trading 24/7, whether they're futures or spot. But for the CME is closed over the weekend. So imagine a scenario where you're doing this basis trade as a traditional institution, and you're doing it using basically Bitcoin and the CME future. And what basically happens is that the CME future is closed over the weekend, Bitcoin's price goes somewhere else, and all of a sudden that basis trade you were doing stops working. And what you basically need to do is, if the price of Bitcoin rallied over the weekend, you need to basically push Bitcoin's price back down. Rather, there's an incentive to push Bitcoin's price back down to that CME gap that was formed over the weekend, to basically fix to fix basically this kind of basis trade dynamic. It's kind of tricky to explain, but the long story short is that when this trade, basically for TradFi institutions, the fact that there's this closure of the CME over the weekend basically causes this basis trade to break, and they either have to sell Bitcoin or buy Bitcoin to bring it back into whatever range it was before the weekend, to basically fix this type of like basis trade so they can continue earning those fees. So it's something that's purely mechanical. This is what people don't understand. The CME gap, yes, of course, there's part of it is kind of emotional, that people are trying to front run that and whatever, but a lot of it is just pure mechanics. It's like you have to fill that CME gap because you have to fix this trade to be back in profit as an institution. And what's really interesting is, of course, because the CME, like I was mentioning earlier, it's only around 20% or whatever it is of Bitcoin's futures volume. What that tells me and what that tells us is that Bitcoin is not nearly as liquid as people say. I'm sure you hear people say, oh, Bitcoin is so liquid, it's the most liquid asset in the world. Well, this technically isn't true. Like, yes, Bitcoin has a lot of trading volume, but there isn't much market depth. And the more that people are holding Bitcoin, like you have MicroStrategy buying up all this Bitcoin, you have all these treasury companies buying up Bitcoin, you have whales that are hoarding Bitcoin or whatever, that actually increases volatility because there's less Bitcoin on the open market that can be traded, and it results in thinner order books. So yes, there's a lot of high frequency of trading, but the market depth is actually shrinking as more and more people accumulate Bitcoin over time. And the result is that the chances of a deviation over the weekend starts to increase, like basically a deviation from the CME starts to increase. And I would argue that that's especially why, let's say over the last 6 months or a year, you've really started to see the CME gap come to attention, is because so much of Bitcoin supply is basically being bought and held. So there's very little of that supply trading on exchanges, which basically results in price deviations over the weekend, and also makes it easy for TradFi institutions to bring those prices back into the range that they want. And that's why you basically see these CME gaps forming and being filled basically all the time. It's actually very fascinating. But the silver lining is that all of this is probably not going to matter in a couple of weeks' time, because in October of this year, the CME announced that starting sometime in early 2026, they would remove basically, or rather, they would introduce 24/7 futures trading for Bitcoin. And what's really interesting is that the global head of equities at CME Group here, he said, and I quote, "While not all markets lend themselves to operating 24/7, client demand for around-the-clock cryptocurrency trading has grown as market participants need to manage their risk every day of the week." And what that basically means in plain English is that he's confirming what I just told you is like, look, like these institutions, because of these deviations over the weekend, they have to basically either buy or sell Bitcoin to bring it back into that range that the CME was trading in before the weekend. And they don't necessarily like doing that, right? It's actually kind of funny because, of course, the implication of, that like Bitcoin is being manipulated by the CME and whatever, or by institutions, the implication is that these institutions enjoy doing this, but they actually don't. They don't want that to happen. It's not ideal for them. It's not ideal for us. So they want it to change, and they asked the CME to change it. And the CME said, yeah, of course, we'll change that. So starting in 2026, we're not going to be seeing these CME gaps anymore. So thank God for that. But, until then, I guess we have another, by the time you see this video, we have another week or two that we're going to have to put up with the CME, or I guess one more weekend to go here. But once that last CME gap is closed, then it's going to be hopefully off to the races. But again, it's not clear when in early 2026. So maybe it'll still be another couple of weeks. But anyway, once those 24/7 futures for CME for Bitcoin come in, and for other crypto markets, because it's not just Bitcoin, they also have Ethereum, I think Ethereum and XRP and Solana. So once all those CME futures are trading 24/7, we will no longer see CME gaps, and that'll be the last that you ever hear of it ever again. So I guess consider this video to be kind of, I guess, a relic. Yeah, if you made it this far, then there's a spoiler. All this information is probably going to be irrelevant in a few weeks' time. So anyways, if you guys do want to learn more about CME gaps, though, you should definitely watch our video on the main channel. This Bitcoin strategy works 90% of the time. Nick explains CME gaps in a lot more detail and a little bit better than I did today. So I would definitely check out that video if you want to learn more. And if you do like this type of analysis, then do become a member of the Coin Bureau Club. That's where we do deep dives into small cap altcoins every single week. Members can vote on which altcoins we review. We have a research feed where I'm sharing this type of analysis, like more fundamental stuff and macro stuff. We have a team portfolio page where you can see which cryptos we hold and which ones we're considering buying. We have an exclusive deals page where you can find discounts on like crypto analytics platforms that will help you with your research. And we have a members only Discord where you can ask us questions about a whole bunch of stuff, including the CME and whatever else. And again, the link to all of that will be down in the description. And if you guys did make it this far and you did find that information helpful, then be sure to smash that like button, subscribe to the channel, ping that notification bell, and I'll see you in the next one.